Hello, everybody. Welcome to this week's Middle Class Investor. This is Seth Martin, your host, and it is Sunday evening, about it's September 10th, about 20 minutes after 8. And I know the programs have been a little bit sporadic recently, and I apologize for that. We had a little Hurricane Harvey situation down here in the Gulf Coast, and then I went bird hunting, dove hunting. And now I'm back and kind of getting in the groove of things. So a lot of people didn't do so well in that Hurricane Harvey thing. We got pretty lucky here at my house, but a lot of people not so lucky. So our thoughts and prayers go out to those people, and hopefully you're not one of them. But if you are, hopefully you can get through it quickly and without too much pain. We've had these kind of storms down here before, and it's just part of living in the Gulf Coast, I think. I'm originally from Dallas, and up there we had tornadoes. So I'd rather have a hurricane than a tornado, though, because the tornadoes are a little bit less predictable, and you just never know when one's going to hit. So I don't like that at all. But anyway, getting to the markets here, we're looking at the S&P 500, and actually we're looking at the S&P. Let's put it on the index. I got it on the SPY, so let me put it on the index real quick. The market has been, I don't know, it's getting, in my estimation, it's getting a little bit tired. We had a down week, not substantially down, but down. And let me get it down here a little lower so we can look at it. And we had this big run up from the election, and then it kind of sold off, and then we've had another second little run up, and then we've had this consolidation here. And it's, to me, there's potentially a couple different scenarios here. One is we got maybe a triangle developing, so that kind of bounces around in here like so, and then it resolves into a higher high. This is probably the most likely scenario. I don't know. This happens a lot though toward the end of a big run, and we've had a big run, and you could argue that this is getting close to the end of the big run, which I am perfectly comfortable arguing. Another possibility is that we're still in some larger pullback, and we've yet to have the larger move down to pull back, and then we rally, make a new high over the next month or so. That's certainly a possibility. The third and final possibility, and to me, the triangle consolidation is probably the most likely, but there is a possibility, because we haven't made a new high yet, that this is a move down, and then this is some sort of correction into that move, and then the next move, in other words, this is laying out a top here. That's certainly a possibility. Until we make a new high, or until we come down like in a triangle and make a low but not a new low, then we can say that, oh yeah, that's probably going to be a triangle. Because a triangle, the lows get the lows get lower, or the lows get higher and the highs get lower, and then you have the final kind of move and then a breakout. But until something happens either further down below this low, or we break this high, or we come down and make a low that's not lower than this low and turn up, it's really hard to say what's happening here. But the point I want to try to make, and it gets back to the initiative. The initiative of this program is this move is getting long in the tooth. let's go back 10 years. Here's your March 9th low, and this looks like a near completed um, Elliott pattern, which I kind of touch on from time to time, but the market is patterned. It tends to move in with the same form over and over again. And I guess maybe the best way to, I've done this before, but I can show you some shorter time frame stuff, and you can see it. Seeing if anything jumps out on the page here right at this moment. Sometimes we can shorten up even more. So here's a good example right here. This form right here, this kind of 1, 2, 3, 4, 5. This happens over and over again in the market, and then it's followed by an ABC pullback. And that's why I'm thinking we're kind of in a triangle right now, is that this is some sort of larger degree triangle. We're probably going to run up to here and then a pullback. Let me go back. Let me back out a little bit, like 20 days. So here's the high. Here's a run down, run up. Maybe the run up's not finished. Maybe we go to here. Let me see if I can draw this in real quick. I need a little bit more space though. So let me go to 30 days. Still need a little bit more space. Let me go to 60 days. All right, let's see if I can do this on here. So if this is a triangle, then this is your first. Notice how this is corrective, A, B, C, and then this makes kind of an A, B, C up, right? Like so. And then what you would expect is some sort of A, B, C down, so maybe this to complete here. And then you get an A, B, C kind of back up to here, and then an A, B, C down to here, and then a new high, then take off to a new high. So that's what I'm talking about. That's why this looks very triangle-ish, because this is an ABC, this is an ABC, this looks like an ABC in the making. Could be wrong. This could be an ABC, and this could be 1, 2. That's the problem with Elliott waves. You don't really know, but it does give you context of where you are in the larger degree trend, and that's where I think it's useful. And bottom line is, when you look at a 10-year chart, you can kind of see something here that looks like a 1, 2, 3, 4, 5. And if that's the case, then a correction is imminent. It may happen this month. It may start happening next month. It may not happen for 3 more months or 5 more months, but it is imminent, because this pattern looks over. When you look at this move from here to here, and then this move from here to here. So, and in fact, you can almost see they're about equal. This move from here to here is about equal to this move from here to here, and that's pretty typical. So I just want to call your attention to that. It's nothing to be afraid of or anything. I mean, the market usually gives you a little bit of notice. Like, for example, we haven't made a new high here. We've come down, we've bounced up, but we haven't made a new high. So this is an alert. Okay, this should put us on edge a little bit about where the market's potential direction is. It still looks like to me that it wants to make a new high, but that new high could be the last high. You never know. So we'll just keep an eye on it and watch it each week and look at market sentiment indicators, things like that, to try to give us some clues as to what it wants to do. It's really hard to tell what it's going to do next, but we can kind of get a clue as to how close we are getting to the end of that. Now here's the volatility index. The volatility is still low. We had this little pop out here a few weeks ago, but then it came right back down into the consolidation. Although it's wanting to bust out, it looks like here. So this kind of goes in. This kind of works in parallel with, you know, the market potentially topping story. Let's look at treasury yields. This is the 13-week treasury. This is the one that we look at to tell us whether or not the Fed's going to raise rates. It's still very, very high. It's at 1.02%, which I think is above where the Fed actually is right now. And it looks like maybe it wants to start curling up here. We'll just have to keep an eye on it and see. But I would say as long as we're above this this is a 30-week moving average. If we start breaking below here and chopping around on the 30-week moving average, they might slow down the raising. But I would say as long as we're above this, the odds are pretty high that they're going to continue to raise. Let's look at the 10-year. 10-year is the one that's the most critical for your portfolio. Notice we had another pullback this week. And the bottom of this box, this line right here, is the midpoint of that large white candle. Let me go back. This large white candle right here, which is a 50% retracement of this move, which is potentially a place where this could turn around. I mean, the yield could continue to pull back, even back to to 1.8 or even lower, but right here where you have all this congestion to 1.6. But again, it's really a question of probability, and how fast you can move in and out of certain things. I mean, if you're in bond funds and you're making money all along in here as it's pulling back, as yields are pulling back, if you can get out of your bond funds fairly quickly, then that's fine to stay in there. But if you're a little bit more complacent and you don't look at your portfolio, but once a year or twice a year or something like that, you should already be out of bonds, even though they're still making money here in the last, 10 weeks or whatever this is. Okay. Just something I've beat on that till it's, can't beat on it anymore, but it's super, super important. Small moves in this treasury market in the bond market can really cost you some big bucks. Let's look at some of the other countries. Germany's been going higher recently. Kind of did this little consolidation, and then shot higher. Just touched our box. Again, there's nothing magic about where this box is located. It's just located off the previous pivot high. And maybe it continues up in this box some more. I think it's just interesting to see that how these markets look really tired. I mean, it took a long time for this to get up here, and you had this long consolidation back. If we go back a little further on the 10-year, on this like on 10-year chart, you can see this is a pretty good little run. Could be the end of like a 5-wave move. So let's look at Japan on a bigger, same thing. Looks kind of the same. This last consolidation and a run up, although it looks stronger. That's probably because they're printing a lot of money, creating a lot of credit in their banking system, which is not a good thing. Let's look at the UK. The UK still hasn't made a new high, so the UK may have topped, or it could be that it's this is some sort of move up, and we're gonna consolidate backwards a little bit and then run up real big. Maybe the UK is the big winner or something in the next in our next bear market. Let's see, Russell. We don't need to look at the Russell. Let's switch over and look at gold and silver. Let me put this on. Yeah, it's on a weekly. Okay, let's look at gold. This gold's been running up for a while now, and doesn't look like it's finished. Looks like it might want to go a little higher, maybe up into this area we've got. But I think this is I mean, there's a lot of overlap here. You can see this run up and almost, a huge retracement down and then another run up. So it's very overlapping, which is kind of indicative of a correction. So in other words, this may just be a bull market rally in a larger correction. So a correction upward in this case, not a correction downward. So I would look for gold maybe to go a little higher. It might not make it to this box, but I think it's going to at least make it just past this pivot. So maybe around 1400, and then maybe gold pulls back a little bit and takes a breather, and then makes another run up higher. But until it gets to this pivot or turns down substantially from here, I would say that gold's got a little bit higher to go. Now, the interesting thing is gold and silver are not working the same way right now, which is a little bit unusual. So that may mean that silver needs to catch up a little bit. So we might have silver, running really hard next several weeks up into this pivot area. Or it could mean that, it could run really hard. Both gold and silver could end up running really hard up into this area. So I don't know. It's a little bit cloudy right now for me. I know that the bulls in the gold market there's pretty high percentage of bulls, which usually means there's a pullback coming, but I just don't have a real good sense of whether or not we're at a turn or if this is going to run further. My gut is this is going to run further. So if you're in gold, maybe hang on to it. If you're not, maybe sit on your hands and wait. See if we can't pick a better place to either go long or short. Oil, oil is, man, is it choppy. Oil stocks still aren't doing very good. There's been some disruptions in the oil market, not so much in the oil market, but in the gasoline market with these hurricanes and stuff. But I don't know. Oil to me looks down. I'm kind of following this thing here. It could be that this whole latter part down here is going to be some sort of triangle and then lower in this last wave. You can kind of see it here. This is a great example of a 5-wave move. You can see a 1, 2, 3, 4, 5. Now, the way a lot of times this works is there's probably a 1, 2, 3 in here, 4. So there's a 3, and then there's another series of waves within this 3. So this could be 1, 2, and then a 1, 2, and so on and so forth. So this still could be 4 here, the larger degree force, because if you go back further, you got this what looks like maybe an ABC in our future. But it's possible that oil has made its low and it's just going to consolidate for a while. Maybe make a slightly lower low, but not by much, and then start rallying again. So oil, to me, unless you're going to trade some spreads like iron condors, and I know we haven't talked about that in there, but unless you're going to sell something up here and sell something down there and collect a credit, there's not much to do, I don't think, in the oil market. It's still not clear whether this would be a good time to buy oil stocks, given the way this chart looks. Let's look at the British pound US dollar. That's one we were talking about, and I was expecting it to pull back a little bit here somewhere, maybe down into here, which would be a great opportunity to go long the British pound if it pulled down in here, which it should, because the US dollar, should start rallying here pretty soon. When I look at the euro looks very stretched, which means the dollar, if the euro stretched to the upside, that means the dollar stretched to the downside. So I'm sorry I don't have a chart for the dollar, but you can see here on the euro that it's very stretched, and it's right at a point where it looks like it should turn. You can draw a trend line here, and I would say that if it breaks this trend line, comes down here, let it come down here, let it rally back up, and then that would be a great place to short the euro. If you're more aggressive, you could get on a daily or like it's a daily chart, and maybe look at drawing a trend line, from here up, and then a break of this trend line. Wait for a break of this trend line, a little rally up, and then short right there. It's good short opportunity in the euro, or potentially a long in the US dollar. It's actually giving us a little trade signal right now. So we have a high, and then we've got this is a daily chart, so you'd have to wait till tomorrow. But if it closes below this low here on this day, that's potentially a good trade setup. And I would say the target would be right down here. Let me put this up here, right below this low here. What is that? 1.1813, something like that. So that's pretty good little trade there if you're looking to short the euro. Let me get off this, back to the pointer. Okay, so what else do we look at? We looked at gold, looked at silver. Let's see what the futures are doing right now. So actually the futures are rallying right now. So what does that mean? That means sorry about that. Can't get this. I want to get this in the screen so you can see it. So, we talked about this being a triangle where this was, let's say, A down, B up. But obviously, if this takes out this high right here, then that's not a triangle. That could potentially be the next set of waves up. 1, 2, 3, 4, 5, something like that. So if that's the case, that could very well mean that we're closer to a top than even I thought. Let's watch this carefully. But if this takes out this high and starts moving up, and then we get a pullback and then another little high, some wiggles here, we could be topping out around 25.25 or so, 25.20, around this 1.618 area. One of the reasons I drew this is because this is kind of a typical, somewhere between 1.1618 and 200% is pretty typical when you're looking at targets. And I'll show you how I got that. If you go to this high here, let me go use this Fibonacci tool. And so if I break out to new highs and I go from the high to the low, a lot of times a good target in a trending market. Now, let me give you a caveat. If this market's topping, this doesn't necessarily hold true. But if this market's trending, let's say it goes up here. Let's say it only goes to about here and then starts to roll over. Well, that tells us that could tell us that we're at a top here. But if it goes all the way to this 200% and then starts to pull back, it might have some more to go. It could pull back and consolidate again and then take off again. So, but interestingly enough, this pullback, that puts us 25.35 to 25.65. It's only a 30-point range. Let me mark that because that's something we're going to want to keep a close eye on. That could very well be the range in which this market tops. So let's put it up there to make a bold prediction. That's not really a prediction. That's just an area where we're expecting the market to go to, and it may or may not go there. But we definitely want to start sounding the alarm if it gets there and starts looking weaker. Okay? All right, everybody, that's it for this week's Middle Class Investor. Again, I'm going to try to be consistent here on the weekends because I think the market's starting to show some serious weakness, and we're due for a pretty decent pullback, the pullback that you probably don't want to experience in your portfolio. So I'll commit to consistently coming in here on a weekly basis and making these videos and help you manage the could be large degree sell-off that we've got coming. All right. Take care, everybody, and we'll talk to you next week. Bye-bye.